On this channel, I love engaging with my friends, followers, and more, and I think one of my favorite series and videos to do on is going over my subscribers' portfolios. I also go over portfolios from other finance creators. We go over every holding, allocation, portfolio value, everything basically you need to know. I share truthfully what I like, what I don't like, what I'd like to see more of, and so much more. And at the end, I give an overall grade and kind of give a conclusion. So today we'll be going over the Dividend Investor's portfolio. Again, guys, thank you to him so much for sending it over. A lot of people, like Jeremy, don't have the transparency and guts to actually show all their holdings and their losses and gains, so big props to him. Also, he has a channel, go check that out. Speaking of channel, make sure to subscribe right now. We promote real man's investing on this channel, learning from our losses and not neglecting them. Also, if you're interested in getting a lot more behind the scenes action from me, exclusive episodes, stock market competitions, and so much more, check out the channel memberships, link in the description. With all that out of the way, roll the intro.
Hello, I like money.
Alright, before we get into the holdings and all that, I really like to know what are the investors' objectives with the portfolio, what's their age, what's their, goals long term for it. So for looking at his objectives, his portfolio value, he wants to have it be at $1.5 million in 15 years. Currently it's $36,000. With consistently investing, guys, it's very doable over time. He's going to achieve this through capital appreciation, dividend growth, and overall total returns by investing in high-quality companies, investing in predictable cash-generating equities, and this is what I like to see. He wants to reinvest his dividends through automated drip, which I think is definitely the right move if you're going to be doing this long term. He wants to keep his portfolio yield between 2 and 4% to keep in pace with inflation. He wants to retire at the age of 50 to 53, which is definitely very solid. And he wants to also educate fellow investors. So first of all, big respect, mad props to him. A lot of people don't actually care what the viewers, they just want to do it for money and, selling their little stupid course. So big props to the Dividend Investor on that one. Big respect. Go check out his channel. I would assume by that knowledge right there that he's in his low to mid 30s, so I think definitely over the next 10-15 years, keep at it. You definitely can reach this goal if you just continue contributing to the portfolio. Continue working, continue being smart with your money. Easy, you got this. He's also a CPA, so we already know he's bringing in that big dough, so expect that portfolio to keep on growing with time. So keep moving on. The portfolio inception date, the date started was 2022, March 30th. So it's a fairly new portfolio. Right now the portfolio has a value of $36,030.67. And every year he's getting $800.75 in annual dividend income. And the dividend yield is 2.22%, which I actually really like. What I think I even like more is the holdings amount, which is 23, which I think is really, optimal. For investors who want to pick and choose their own companies, kind of like me and the Dividend Investor over here, you don't want to just buy an ETF. Picking companies and studying businesses really gets you involved. And we can see just how the portfolio value has grown over time. Just in this year and a half it's been since the inception date, really, with those annual contributions. So definitely keep that up. That's going to be big. Just continue investing money. Keep putting money into your account consistently, and it'll definitely grow along with time. I definitely think 23 is a solid amount of holdings. I'm personally around like 25, 26. That range, but I think 23 is a very good amount, and I approve of that for sure. When it comes to actually like the allocation itself, there's no crazy outlying positions, which is definitely a good thing when it comes to diversification purposes. Biggest thing I see right now is around 11%. Alright, let's move on to the sector allocation before we get into the holdings. And for him, this is going to be really important, especially for these retirement portfolios. If you're close to retirement age, diversification is definitely a lot more important. Is that dividend income source and the stream of that is definitely going to be needs to be diversified for sure. Alright, to start off, his biggest sector is tech at 19% of the portfolio. I'm assuming he has Apple and Microsoft, and I definitely am fine with it being near 20%. Tech, I don't think it has you're not investing in tech for the dividend itself, but I do think over time it will provide some really solid returns. Next, he has an industry that I really like and that I'm studying up more on right now, which is railroads, coming at 12.8% of the portfolio. Railways are very monopolistic and very high barrier to entry, hard to compete with. I definitely approve of that. Next, he has Canadian banks coming in at 11.7% of the portfolio. In the comments section, I have a question for you here. I'd hope he responds in the comments here. What's your thesis on Canadian banks compared to U.S. banks? I'm no expert on them whatsoever. Judging from the sound of your voice from your videos, you have a little Canadian in you, I could tell. So I'd like to hear your thesis on that. I'm very curious personally. Next, he has consumer discretionary at 11% of the portfolio. I like that. I think over time, consumer discretionary is definitely a right place to be at. Payment processing, another industry that I love, coming at 9.9%. These are definitely some solid industries and sectors to be in, especially, when it comes to yield and growth, I think. And I think the dividend investor, I think he's doing it the right way, especially, he has a much lower portfolio yield for a quote-unquote retirement account, being at 2.2% right now. He could easily put that in Altria or some other high-yield stocks that don't have really good total returns over the long term, and he could easily have a 4, 5, or even 6% yield. That's another thing, big props to him. Next, he has U.S. banks coming at 9.6% of the portfolio, which I also like as well. I think they're very cyclical. I personally don't own any banks. I just don't know enough about the business personally, and I don't like to invest things that I don't fully understand. Next, he has 1.2% of his portfolio in cash. Now, obviously, with everybody saying a recession is coming, I'd like to have a little more cash on hand. I'm not one to judge, though, as I don't have a lot of cash me personally, but it's something that I'm definitely working on. But I would definitely consider having more cash on hand, especially with some potential buying opportunities as some of the holdings we'll get into. He has semiconductors making up 5.1% of the portfolio. I like semiconductors. I think they're going to be heavily involved with, society in the next 40, 50 years, so I definitely approve that. Next, he has alternate asset management. So I don't know whether this is like an ETF or another portfolio or something inside of the portfolio managed by somebody else, or the actual companies that he owns that manage people's portfolios. A little curious on that one. Next, he has real estate at a solid 6.8% of the portfolio, wealth management at 3%, and life insurance at 2.7%. So I definitely like the diversification here. Very well diversified, and you can kind of clearly tell which industries he's bullish on long term. Honestly, I can't find anything really wrong with the sector allocation here. I think it's a thing of beauty. Now let's move on to the bread and butter here, the holdings of the portfolio. Alright, to start off, we have 3.2% of his portfolio in Realty Income. I love Realty Income, and I think it's definitely a solid company to have in your portfolio, especially with your investing goals, your time frame, etc. Moving on, he has 11.2% of the portfolio in Microsoft, and I definitely approve of this one. Microsoft is just such a high quality company, and over time I think they'll be one of your biggest gainers for sure with their buybacks, dividends, and other ways they reward the shareholder. Not only is Microsoft's core business strong, but I think their diversification in the business segments they have, and I think their potential with Xbox and their gaming business is really going to set them apart over the long term. I definitely like where you have it when it comes to your allocation too. I think 10 to 11% is a really solid place for Microsoft as a core holding in the portfolio. Next is Apple, coming in at 7.8% of his portfolio. Apple, just like Microsoft, very strong company. Over the long term, I do hope that they can continue growing their dividend, as they are putting a lot in buybacks right now with not the greatest growing dividend. But I think over time, as they really do aggressively keep on buying back shares and they mature as a business, I think that dividend growth will be incredible. Right now, he has Apple at 7.8% of the portfolio right now, and I think he can move that up to 10, 11%, kind of up there with Microsoft. But it is a bit of a core holding right now, which I definitely approve of. Next, he has TD, the Canadian bank, at 7.8% of the portfolio. I can't really make a comment on this. It is obviously a Canadian bank. I have used Ameritrade in the past, and I have had a solid experience with it. But as a company, I don't know much about it, and I'm not going to make any crazy comments here. But I'm assuming, especially since he's a CPA and he's Canadian, he knows something that I don't about them. Again, hopefully some clarification in the comments regarding your thesis on it, etc. Speaking of Canada, he has Canadian Pacific making up 5.6% of the portfolio. I love the railway exposure here. I already kind of spewed my thoughts out about railways already. Very high barrier to entry, very monopolistic features in them, so I'm definitely like this position a lot. Canadian Pacific versus Union Pacific, I've heard that debate a whole lot. I think both have their own traits. I think Union Pacific has a lot more potential for growth, especially with the new CEO, Jim Vena. And I think Canadian Pacific, they're going to just keep on doing their thing right now. But definitely you can already see the Canadian companies and its influence in his portfolio, and I'd like to see it. Next, he has JP Morgan making up 5.3% of the portfolio. So with already some of the stocks that I've seen, I could tell that he's very bullish on banks long term. As I mentioned, I'm not an expert on banks, so I don't personally own any. But I think JP Morgan, if I were to buy a bank, looking at their financials right now, that would be the one to buy. Moving on, he's Texas Instruments, making up part of his semiconductors at 5.1% of the portfolio. I like Texas Instruments, and it's becoming a little attractive at these prices right now, but I'm doing more research on that company currently.
And hey, you, right there, do you want me to go over one of your portfolios? Join the Discord link in the description and message me from there. On to the video.
Next, he has American Express, making up 5.4% of the portfolio, and I have not really looked too deep into this company before, but taking a quick look on DividendData.com right now, they have very strong free cash flow growth, they have a very strong growing dividend, and have bought back shares at a pretty aggressive rate recently, so financially it looks very sound as a company, and I'm going to be doing more research personally, but looking financially at this company, it looks very strong, and I approve of the position. Speaking of financially strong companies, guys, next we have Visa making up 4.5% of the portfolio. And me personally, I would not be afraid to up that Visa stake a little bit and make it one of those 10% companies with Apple and Microsoft. Visa is just such a financially sound company, and if you can really buy in, if they go on a dip here soon, guys, if it goes below 230, I will do some unspeakable things for a huge dip on Visa. If you couldn't tell already, I am very bullish on Visa long term. I'm very bullish on the advantage that they have with their payment processing network over other companies, smaller fintech companies. I love Visa so much, and I think it should be up there with the Apple and Microsoft when it comes to that core holding 10%. Next is UNP, making up 3.2% of the portfolio. Union Pacific, another very strong railway company. That and Canadian Pacific really gives him some solid exposure to railways, and it's made it clear that he's very bullish on railways long term. Next, he has Brookfield Corporation, making up 7.3% of the portfolio. And quickly looking at this one on DividendData.com, I'm not too sure what his investment thesis is here. It doesn't really, fit in with some of the other stocks when you look at it financially. But I am no expert on this whatsoever. I'm sure he has his own thesis on there, so I'm not going to make any comment, but it just does look kind of like an outlier, especially 7.3%. Very curious to hear his thesis there. Next is Bank of America, another very strong bank, a Warren Buffett holding at 4.3% of the portfolio. Very strong company to hold. Next is Costco, coming in at 4.2% of the portfolio. Speaking of very strong companies, that's an amazing retailer to own right there. Costco right now, you see a lot of other retailers that are dealing with theft issues. Costco is less susceptible to that because of their business model. There's only one entry, one exit to each store. And I think Costco's over time just really, being outlined as that premium company to own. And it's being valued like that as well. Costco pays a growing dividend with occasional special dividends too, and is a cash generating machine. Next, he has Lowe's, making up 4.1% of the portfolio. Lowe's and Home Depot basically have a duopoly on the home furnishing part of things when it comes to retailing. Lowe's, very strong company, very aggressively growing dividend. I do have questions of how aggressive they'll continue to grow it, but it definitely is strong right now. And it's a company that I'm interested in on any big dip. I'm hoping that them and Home Depot have a cyclical dip once real estate kind of goes down in price. Next is Royal Canadian Bank, making up 3.9% of the portfolio, kind of continuing on that trend of Canadian companies. You can just see the influence in his portfolio. You can clearly tell that he is a Canadian. So I don't have much room to comment here. I don't really know much about Canadian banks in general, so I'm kind of going to go over that one, but I'm sure he'll let me know in the comments. Next, he has T. Rowe Price, making up 3% of the portfolio. I think T. Rowe is a very cyclical company. During bull markets, it's going to do great. During bear markets, it's going to do poor. It's a company that I'm still researching at the moment as well, but I'm not particularly looking to add. And his last holding is Norfolk Southern, making it 2.8% of the portfolio. You can continue to see the railway influence on the portfolio, and I definitely approve of this position as well. Railways aren't going anywhere. Norfolk Southern's an amazing company to own, and financially they look very strong, along with the other railways in his portfolio. Alright, that's his portfolio, and now here are my thoughts. You can definitely see the Canadian influence in some of his holdings. Personally, I'm not huge on Canadian companies, but I'm sure he knows something that I don't, especially considering that he's a CPA and he's Canadian. I think he's really allocated a lot of good capital in a lot of very quality industries and sectors like payment processing, tech, etc. I think he has 3 or 4 companies that he could potentially sell out of, and he could reallocate that money into a company like Visa on a dip and making up one of those core positions in the portfolio. Overall, though, the holdings are very strong. I'm happy that he's not completely chasing yield, especially if we're looking to retire off this money eventually. 2.2% yield right now, very conservative compared to other retirement, portfolios that are in the 4 to 6% range. He's also focusing a lot on dividend growth and the business's fundamentals itself looking at these companies, so I'm very happy that he's doing that. On a scale of 1 to 10, what would I rate his portfolio? It would definitely be in the range of 8.5 to 9.2. I don't know where exactly I'd put it in there, but it's a very solid portfolio. He has a lot of exposure to Canada, a lot of exposure to banks, which I'm not completely bullish on myself, but I'm also not completely informed, so I'm not going to completely drag him down for that. But overall, a very quality portfolio. Thank you to the Dividend Investor for allowing me to go over his portfolio and, of course, promoting transparency amongst the finance community. He's probably the biggest no BS YouTuber right now, one of the bigger ones at least. His channel's growing. I'll leave a link to his channel, link in the description. Go check it out. I can appreciate a man who has Walter White with money as his profile picture too. Alright, if you haven't already and you want to go the extra mile, check out the channel memberships, link in the description. If you want to get access to all sorts of cool perks, exclusive episodes, stock market competitions, and so much more, check that out, link in the description. Alright, thank you if you've watched to the end of the video. Make sure to subscribe, turn on post notifications, smash the like button, and of course, do dividend stocks, not drugs. Have a good one.